All right, I am here with Jess from Fran Fun. Thanks again, Jess. Appreciate you.
Thank you, Lisa. I appreciate you too.
So, everybody understand one of the things when we start working together, sometimes my answer is go talk to Jess and figure this out. And it's not to figure out exactly to the penny what you need to borrow because you don't know yet. We haven't found the business for you, but we do need to have an understanding of where your reach is, right? We have to understand when we're talking to each other. My biggest thing is that it's like car shopping. You don't want to look at the Mercedes if the Camry is the car for you and it's a perfectly good car and it's going to get you where you need to go. Don't look over here, right? We're going to waste our time and it's just going to be just an error, right? So talk a little bit about, I think what I would guess is one of the most popular ways to fund small business, and it's going to be with an SBA loan. Talk a little bit about what the SBA loan is, why it's the thing that we all talk about all the time.
Yeah, absolutely. And SBA loans are very commonly used for business startups, whether it be a franchise opportunity or a concept that you've developed. And these are loans that you're borrowing directly from a banking institution, but that are guaranteed by the Small Business Administration.
Okay.
And that additional guarantee from the SBA, the Small Business Administration, is going to give the lender a bit less risk, a little more openness to different types of businesses and borrowers. Because ultimately, and we hate to look at things from this perspective, but if there is a business failure and the bank is unable to recoup the funds from the borrower, then they can recoup a portion of the funds from the SBA. So like I said, it gives more opportunity and a stronger appetite from the banking level for startup business loans and business loans in general.
So it doesn't mean that they're going to pay my loan back if I default. It's not that level of...
Correct.
Why the bank? Why the bank is like, okay, if it's SBA approved, we can go forward.
SBA approved means that the franchise has submitted their franchise disclosure document to sba.gov. Someone has reviewed it, ensured that it meets the criteria for a franchise, and thus SBA lenders can provide loans for it. You know, different banks have different appetites for project cost, for industry. Where the benefit comes from working with Fran Fund is we have a deep bench of SBA preferred lenders that we've cultivated relationships with, and we help folks get pre-approved for and then package and pursue their loans through that network and with our team's support. We've been doing this for many, many years. We actually have a team dedicated to partnering with our franchises, ensuring that at the franchise level, there's an understanding of the financing component, and then also going back to the lenders that we work with to ensure that there's appetite, that we have a fit for the different businesses that we're working with. Whatever franchise you may be exploring, likely our team has experience. And if we don't, we can get familiar really quick and we can get our lenders familiar quickly as well.
So what are the banks looking for? Or do I say, what are you looking for? When I send someone over and you say, okay, they're a great candidate for the SBA, what are you looking for there?
What does that mean?
Yeah.
And there's 4 primary requirements that any SBA lender is going to look for. There's a standard operating procedure that these banks have to abide by.
Okay.
And so at a baseline, you would need to come to the table with favorable credit, meaning a score above 680, minimal credit card debt, and no major events in your recent credit history like a bankruptcy, foreclosure, or short sale. Those are the big ones. Okay. And if you have something like that in your history, it's not necessarily a deal breaker. If it's 5 to 7 years in the past, oftentimes we can overcome that and it's not even a challenge, but good to be aware of.
Okay.
So in short, favorable credit. From a cash perspective, there's a couple of requirements at play. Lenders will require that you come to the table with some money that you're prepared to spend. Generally, a cash injection ranging from as little as 15% as much as 30% of the total investment. And where you fall in that range, it depends on the business. Is this an emerging franchise where there's only a handful of open locations? Mm-hmm. Or perhaps it's a larger brand with a big footprint and you're a really strong candidate with a solid financial picture and excellent credit. But regardless of where you fall in the spectrum, as long as you're meeting these baseline requirements, there's option forward. And in general, what I'm seeing often, Lisa, is most of the time the bank is requiring about 20% down. Yeah. 30% more of an outlier for those brand new franchises, or perhaps an individual that maybe could be required to put up collateral against the loan, but if they're putting down more liquidity, perhaps they can avoid that. And then again, for a really strong candidate, there could be lower injection options as well. Something we'd be able able to set your expectations for with our more formal pre-approval process. We've gone over credit, cash injection. Those are the first two.
Okay.
The third would be displaying personal cash reserves, or at the bank level, they'll refer to this as post-closing liquidity. Usually about 10% of the project cost, depending on outside income. And to that note, not having W-2 employment, not necessarily a deal breaker. There are certainly banks out there that are comfortable if you're not employed, but you have a stronger liquid position. Perhaps the ability to cover your personal expenses for 12 months on top of that 10% reserve. Flexibility depending on the overall scope. And a final requirement, number 4, would be leveraging a personal asset as collateral against the loan. Now, this doesn't always come into play. It depends, as many things do. And if you're pursuing a loan amount above $350,000, then personal collateral would be a hard requirement at the bank level. That's where the SOP, the standard operating procedure, comes in and dictates. But if your loan amount is less than $350,000, there could be an opportunity to avoid personal collateral. And we work with a number of banks that are comfortable with no collateral on loans below that threshold.
Got it. Thank you. And I think that's important. I think a lot of people say, whoa, I'm not going to put my house up, right? And so when they're saying that, and I understand what they're saying, but the other answer I think too is like, the bank doesn't want your house.
They don't. They're going to exhaust their efforts before that even comes into play.
Absolutely. Absolutely. So thank you for that. I appreciate it. I think there's a lot of noise around that whole thing, and people talking, and it changes all the time. So I appreciate kind of cut and dry. Have about 20% of the total investment available down, have post-closing liquidity, 10% of whatever that loan is going to be, and we should be okay with good credit.
Yeah,
right?
Absolutely.
Good. Thank you. Thank you for watching. If you're ready to take the next step, Integrity Franchise Group is here to help. Click the link below or reach out to us today to schedule an appointment. Let's work together to solve that franchise puzzle and turn your business dreams into reality. We cannot wait to connect with you.